So today, once again, I've got a Sunday video for you guys, and today I'm going to be sharing with you a stock that I might buy. I have been doing some research into this stock in the last few days, and it has really interested me. And in fact, the only reason why I haven't potentially bought this stock yet is that I'd like it to get a little bit cheaper. I would ideally like another 10% drop on the share price, and then I could become a buyer of this stock. Now, the thing is that UK stocks have been on a very good run recently. So if we have a little bit of a cool down, a little bit of break in the UK stocks, maybe we see that stock then drop and then I become a buyer. Or the other thing is that it recently came out with a really good trading update. That trading update has seen the share price do really well. And if it has a bit of a cool down since that trading update, potentially then I get a little bit of a drop and I come buy this stock. But yeah, overall I think it's something that I'm really interested in, and I thought I'd share the research I've done with you guys on today's video. So hopefully this video is useful as always, and if you could hit the like button for me sharing this information with you and doing this research and saving you some time, that'd be absolutely amazing. Let's get stuck onto this stock. Now, really quickly, I dropped an earnings review video on the Patreon, so if you're on the Patreon, go check that out. If you're not on the Patreon and you'd like to see it, join through the link in the description. It's half an hour long. We talk about some stocks that we can't always talk about on the YouTube channel because there's a million stocks we could talk about, but it's an earnings review of S4 Capital, who are Hostel Chocolate, Netflix, and the Hook Group, which brought earnings out this week. So if you do want to see exclusive videos on there, there's 2 a week normally on there. Join through the link in the description. I also post what I'm buying in real time and selling in real time, and there's a Discord with 600 members on to talk about stocks, and that's also the best place to get hold of me. But apart from that, let's get stuck onto this stock. So this stock is, or this company that I am interested in and potentially might buy, is MoneySuperMarket. So this company is on the London Stock Exchange. The ticker symbol is MONY. Obviously, it's a comparison site. This comparison site offers car insurance, home insurance, travel insurance, life insurance, pet insurance, credit card deals, loan deals, mortgage deals, mobile phone deals. And by the way, I actually had a quick look on there the other day when I was putting this video together, and I actually found one that I was quite interested in. Broadband deals as well. Now, if you look at the company here, you'll be able to see the stock actually did IPO in 2007. Since then, it did get hit by the Great Recession. From there, though, the stock had performed very fantastic up to around about 2020, and then recently the shares have lost over 50% of the value, and it's now a 1 billion market cap, trading at 19 times earnings, paying a 5.4% dividend yield. So let's get stuck into this share price straight away. Why is the share price declining so much? Well, if we go on the recent trading update, it was actually really good. The best overview is if we get stuck onto the financials. And you'll be able to see financially, this company was doing really well, growing revenue and profit. And then 2020 came around, and you'll be able to see this decline in revenue and this decline in profit. Profit margins got shrunk, revenue shrunk, and profit also went down. And you'll be able to see here, they're just slightly starting to put a bit of a recovery in now going forward. So what caused this company to have revenue and profit decline in 2020? Well, you're probably already thinking, I probably know what it is. When you're offering some of these services got hit. For example, travel insurance. So that is one of the markets that got really hit for MoneySuperMarket. And you'll be able to see here that that is actually starting to recover massively in the recent update. That actually recovered 204%. But you'll see in the recent update that insurance was growing at 10%, some good recovery there. The money part of the platform was growing 42%, which is good. But home services declined 26%, and also the growth was down 51% for the 9 months. So we're starting to see one of the issues in 2020 recovered, but what is the home service issue inside the business right now? Well, the energy price gap guarantee. We know comparison sites have been shut down from the energy price cap at the moment, and there's not really that much competition for prices in the energy sector at the moment. And this has been going on for around about a year now, and that's now affecting the business. So unfortunately, MoneySuperMarket has had 2 major issues that affected the revenue in the last 2 years. It's had the travel part that's affected it, but is now coming back. And now you start to have the energy part of the business that has been affected. And we're still waiting for that to come back. Whether that will be in 2023 or not, maybe 2024, but that's obviously one of the issues that are affecting the business right now. And because of the decline in revenue and profit, that is why the share price has been hit by 50% at the moment. Now, even with all these issues that MoneySuperMarket has had, it's trying to move forward. It made an acquisition of Quidco. So you might know this website. It's a cashback website, as you can see here. And it made this acquisition in October 2021. And that's proven so far to be quite a good acquisition for this company. It's also the owner of Money Saving Expert, which you might know as the founder of Martin Lewis. And obviously he is offering how to save money. Also, he has a TV show. And that's also a good tie-in that you have there with Martin Lewis also pushing this site here. And at the moment, when you're having a tightening spend on the consumer, what is the consumer wanting to do? They're obviously trying to save money. Someone like Martin Lewis has really gained popularity in the last kind of few years for that, and because of him on his ties as well to Money Supermarket, I think he's great. And also people are more and more aware of using comparison sites to save money. Now the great thing with Money Supermarket is that they're the number one player in this space, and also they offer multi amounts of these products here, where basically if you were to have an account and you are using Money Supermarket, you're going to go to Money Supermarket for car insurance, you're then going to use them for home insurance, then use them for travel insurance and life insurance. And the more you get tied into using Money Supermarket, you use more of their products. A lot of the other kind of competitors in this space only really focus on, say, one of these products, but the fact that they're able to offer a lot more gets you sucked into the platform, and you tend to stay with your comparison site that you historically use. Now, going on the recent update, considering they've had some issues with the energy cap situation, the company's posting really good financials. You look at the revenue, it was up 33%. Excluding the acquisition that they made of Quidco, you'll actually see that the cashback, it was up 15%, which is really good. So insurance is doing really well. The money products at the moment, there's a lot of money products come back online, and that's seeing really good growth. Home services is obviously affected by the energy situation at the moment. You got travel rebounding really well, and then you've got obviously no comparison for cashback because that was a new acquisition that they made, but you can see here is offering good growth at the moment for the business. Now you can see here they did mention the closure of the energy switching service at the moment, but they said that in the outlook, our Q3 performance was ahead of expectations, particularly in money. Factors affecting our performance for 2022 are unchanged from those outlined in our interim results in July. The board expects full year EBITDA to be towards the upper end of market expectations as well. So they are starting to push back into profitability a little bit more. The reason why profitability also dropped is because of the acquisitions they made, and they've also been making a few more changes inside the business as well. And they should start to see some rewards in the next few years going forward. Now at the moment, the company trades at 19 times earnings, which is actually historically about average for this company. You'll be able to see here that Money Supermarket, for the P ratio between December 2017 and 2021 averaged about 20. So you can see here at the moment, Money Supermarket is quite fairly valued on a P basis. But the big thing is when we look at the previous financials, you'll be able to see here at the moment, Money Supermarket is currently getting fairly valued off the current profit levels. So at the moment, profit is not going to be forecast on what it's done previously. Now, when you look at the previous growth, obviously you've had in 2019 or any of the previous years, 2017, 2018, 2019, what have you had in this period? You've had nothing affecting the business. And since then, you've also had the energy price cap and obviously the travel impacts. The travel impacts are basically starting to get resolved inside the business. You also now have obviously the energy situation. Now ultimately the energy situation could carry on for probably another 12 months. However, at some point this energy situation will be resolved. Wholesale gas prices are coming down massively, and sooner rather than later the energy price cap guaranteed will be removed. Depending on the time frame, we could see it in 12 months, potentially we could see it in 24 months. But at some point, energy price caps are going to be removed and energy comparisons and switching will come back, and Money Supermarket will really benefit from that because everybody will be looking to switch their energy tariff. So at the moment, what you're seeing here is analysts are starting to forecast in a return to good amounts of profit growth and revenue growth when the energy situation comes back, which is in particular getting forecast not as much in 2023. As you can see here, the profit is to remain stagnant and the revenue to stay stagnant. But in 2024, we should see revenue growth really start coming back for this business, and we should also see profit potentially come back as well. And you'll be able to see here if they're, as analysts are forecasting, earnings to return to 87 million, which is still below 2019 levels. But if they were to return to 87 million in profit, you can see here the company then trades at somewhere like 14 times earnings. So you'll see here that by then the company will be trading below its average P ratio, which is around about 20. So you can see here at the moment, most of the share price and most of the forecasts at the moment for Money Supermarket are valuing Money Supermarket to not return back to the levels they used to do in the likes of 2018, 2019, and at the moment it's not factoring potential profit growth and revenue growth where analysts are forecasting in 2024. So if they do achieve what they are expected to do, then we should see this do very well, because the share price will be undervalued, and you can see here at the moment it's not factoring any sort of return on the energy market, which I think will happen in the 2 years, and we'll see earnings and revenue increase, and then we should see the share price do really well for MoneySuperMarket. Now, moat wise, this company obviously is not the biggest moat in the world, a very competitive space, but the great thing with MoneySuperMarket is they do have branding power, and they do have customers that seem to stick with the platform, and because they offer a lot of products, once you use one product you tend to go use other products. And there is some kind of moat here, because you might or might not be aware, Google actually tried to enter the comparison website in 2010. They entered the UK comparison website in 2010 when it was really starting to explode, but since then Google has exited its compare products. It did this in 2016. So you'd see here that they had a 6-year shot at it, and Google then realized, okay, it's actually really hard to attract customers, keep customers, and it's quite hard to build up a successful platform. So you would see here that if you thought, could any company in particular come into the comparison website, you would probably bet at Google, but even they found it hard to enter this sort of space. One of the recent worries with MoneySuperMarket is Amazon is potentially looking at entering, or it has entered the UK insurance website. So that spooked a few people, but at the same time, if Google failed to do it, are Amazon going to fail to do it? We'll see what happens there, but I think that Amazon will need to be pumping a lot of advertising spend to get anywhere close to where MoneySuperMarket is at the moment. Now, given MoneySuperMarket came in with very good revenue growth, even with the effects of the home service revenue declining and profitability also coming ahead of expectations, this showed how well diverse MoneySuperMarket is with all the areas that it's in, and how resilient it has been, that if one part of the business is affected, it can still put in very good financials. Now, unfortunately, that has meant recently there has been a bit of a pop in the share price since the trading update. As you can see here, the stock is up 20%, and that's why ideally I would like the stock to come maybe back down to that below £2 range, and it could be a little bit more of a better value. I'd be picking that at somewhere up then between 16-17 times earnings, and also that dividend yield will be more towards a 6% range. Now, financial health wise is a pretty safe company. It's around about 42% debt to equity. I'm a little bit unhappy that they have recently took a little bit of debt on here. That's one of the two negatives that I do have with this business. But you'll see here they do sit on 28 million cash and 84 million in debt. So that's something that I don't like, and this is probably the reason causing this, which is the second point that I don't like with this business, is they through the CV situation, they did not cancel or reduce their dividend. So they carried on having quite a high dividend yield through this situation here. Now, because the profit was coming down, as you can see here, and the dividend was staying roughly the same sort of payout rate, that put a lot of pressure on the earnings payout. So the earnings payout is over 109%. So they're basically paying out cash they currently don't generate, or profit they don't generate from the business. Now, that's obviously some impact on why the cash balance has gone down, and potentially some reason why they've took debt on, which I'm not a massive fan of. So this is something that I don't like, is that the dividend is currently looking a little unsustainable there. So hopefully they can resolve that a little bit. I would be happy with them to reduce the dividend slightly. But the thing is if they do go back to the profit that we are expecting, then the payout ratio won't be as bad and it'll be okay. But that is something just be careful of, is that they currently are paying out a lot of their earnings. But once again, give it a little longer and the profit does come back, then it obviously is a sustainable dividend. So that's just one thing that I would point out there. Now, recently they did go through a CEO change during the CV situation, where they brought in Peter Duffy, as you can see here. And since the CEO change and the share price has been declining, the really good thing is that there has been a ton of insiders picking up shares. So you'll be able to see here that the chairman of the board did pick up quite a few shares, and you'll also be able to see the CEO did buy a chunk of shares on the 3rd of November here. And also, once again, the chairman of the board picked up a ton of shares up here. So this is a really good sign. When your share price is getting beaten down and it's down by 50%, and your insiders start picking up some shares, that's obviously a really positive sign. Now, the reason why they're probably picking up some shares is they're probably staring at this going, okay, good dividend yield, pretty cheap valuation, getting valued our energy business doesn't come back, which it probably will do in give it a year or two's time. Combined that with that we've just brought out a really good trading update, you can see why some of the insiders are picking up some shares, which is really positive. So clearly they're thinking that the momentum they've just brought out from this trading update will continue. So that's really positive as well. So overall right now, the company does look quite fairly valued. However, it seems like the market is not considering at all that the energy part of the business will come back. You combine that when that energy business comes back and the profit and revenue they will generate from that, and also the new addition of the cashback, this company then will look quite cheap and the share price should give some upside. As well as that, you combine that with a 5.5% dividend yield that should be sustainable once that profit increases and potentially then gets hiked up when the energy parts of the business comes back. I think it's really good value. Now the issue is that it did have a bit of a pop recently, so if it could have another 10% drop and then it trades somewhere towards the 17 times earnings and a 6% dividend yield, that would be definitely more attractive as a pickup, and that's ideally what I'm waiting for. And I think as long as you can wait maybe a year, 2 years until the energy situation does come back, then you should see the share price get a really good reflection. The only issue is that during that time, we don't know when people are going to jump in and play that game of, okay, the profit's going to go up because the energy situation is resolved, and then it goes on the share price run. So we're kind of in the situation now where it could be a bit of a choppy wait for the next kind of 12 months, but I think in the next 12 months when people realise that situation and the profit that they will generate and the profit that will come back, I think you'll see a few people jumping into this one. So yeah, that's one that I'm really keeping on a watch list, and ideally, like I said, a little bit cheaper, that would be the ideal situation. So I hope you enjoyed this video on Money Supermarket. If you could hit the like button, that would be absolutely amazing, and I'll catch you in a bit.